Good afternoon and welcome to lecture 14 of ETC 779. In the previous class, we had discussed about different methods of depreciation, and we had found what are the impact of depreciation and other tax considerations on evaluation of alternatives. So, what you could have noticed was we were all the time drawing the post tax cash flow diagram based on some type of depreciation methods, and then our analysis was based on post tax cash flow diagram. Whereas before previous class we were all the time considering pre tax cash flow diagram, which was not taking into consideration depreciation and other tax considerations. We discussed different ways of calculating depreciation, although I restricted my discussion in very brief terms. We discussed mainly a straight line method of depreciation, sum of years digit method of depreciation, double declining balance method. These three methods primarily we discussed, and then we found out how to draw the post tax cash flow diagram and how to draw subsequent conclusions based on this post tax cash flow diagram. Now, depending on what method you choose, you can use a post tax cash flow diagram. For example, you can use the post tax cash flow diagram for present worth method, for future worth method, for annual cost and worth method, incremental rate of return method. Whatever analysis we were doing prior to depreciation and tax considerations, all those analysis techniques are applicable for post tax cash flow analysis. Now, in this particular class, we will start with one simple illustration which will further reinforce your concept of depreciation and tax consideration on evaluation of alternatives, and then towards the later part of the lecture we will be covering the different methods that we utilize to evaluate public projects. See, till now whatever methods we discussed, those are primarily used for private projects where profit is the main motto, main objective. Whereas if you see public projects such as construction of dam, construction of infrastructure, and other public related projects, you will find that profit is not the main objective. There are different considerations when you evaluate different public projects. There also you will have to generate number of alternatives, and depending on the technique that you use, you may have to take certain decisions. So, these two things we are trying to cover. In first part, I will explain you one example in which I will take all the three methods of depreciation that we have discussed in previous class, and we will try to see how to evaluate those alternatives. And in the later part, we will be discussing the selection criteria, or let us say the evaluation process for public projects. So, these two are our objectives of today's lecture. Now, in this particular example, I have taken three cases. One in which you are given the information on income. In case 2, you are given the information on expense, and case 3 we will see when we have got both the information on income as well as expense. So, these three conditions we will be illustrating you. So, if you just see this particular slide, you will find that this particular slide deals with the situation in which income alone is given to us. So, for this particular illustration, I assume that some purchase of equipment has been made at a cost of rupees 3.5 lakhs. 1 lakh, I will again repeat it, it is 100,000. So, 3.5 lakhs we are purchasing some equipment, and its life is 5 years. So, cost is 3.5 lakhs and it is going to last for next 5 years. Now, to simplify the calculation, I assume that the salvage value after 5 years is 0. So, salvage value after end of service life is 0. Now, I further assume that the gross income for all the 5 years, it is let us say 2.5 lakhs. Every year let us say you are earning 2.5 lakhs, and I further assume that there is no expense. It is purely a hypothetical example to illustrate you the process of depreciation and tax consideration. So, what are the things that I have given you? The initial cost is 3.5 lakhs. It is expected to last for 5 years. Salvage value is nil, and income for all these 5 years is estimated to be 2.5 lakhs, and there is no expense. So, can you draw the pre-tax cash flow diagram for this all these information? Please draw the pre-tax cash flow diagram, and then using 3 methods of depreciation: straight line method, sum of years digit method, and double declining balance method, you draw the post tax cash flow diagram. So, this is the task for you. First step, draw the pre-tax cash flow diagram. Second step, A, take a straight line method of depreciation and work it out the post tax cash flow implications. B, you take sum of years digit method of depreciation, work out the post tax cash flow rate, and finally the last one, take double declining balance method and work out the post tax cash flow diagram. You will find that in all the cases the total depreciation would be same. Where does the difference come? It is in the timing of depreciation for different years. Similarly, you will find that, you will notice that the total tax implication remains same. Using all the 3 methods, you will find that the total tax in monetary terms remains same, although their worth may vary because of timing of the payment of taxes. That is very, very important, and that is why you will find that companies and government, they always have a different opinion on the timings of these tax payments. So, because their interests clash, and that is why you will find all the time that there is some argument put by one party and not agreed by other parties, and so on. So, this example will illustrate you very clearly which option the contractor would like to opt and which option any government would like to adopt. So, this particular example, all the 3 cases, we are trying to see how it varies, although the total tax and total depreciation would remain same. So, if I were to draw this pre-tax cash flow diagram, it will look something like this. If you just see the slide, it would be something like this. I have purchased the equipment at in let us say 3.5 lakhs. So, it is going out of my pocket. So, here I write 3.5 lakhs. No, this is wrong. Why? Because I am showing it in plus side, which is not correct. So, I change this, and using our convention I write it in the negative side. So, here I am purchasing equipment for 3.5 lakhs at time t is equal to 0. So, this is as far as statement 1 was concerned. Life is 5 years. So, 1, 2, 3, 4 and 5. Salvage value at t is equal to 5 is 0, and every year you are getting a income of 2.5 lakhs. So, I show it in positive direction and I write it like 2.5 lakhs. This is my plus side showing income, this is my minus side showing the outgoings. So, whatever information is given to you, I have converted it into a pre-tax cash flow diagram. So, this I will write pre-tax. Now, since we have to consider depreciation and tax consideration, I will be using a post-tax cash flow analysis which will take care of my depreciation and tax consideration. So, let us say in first case I use a straight line method of depreciation, SLD I will call straight line depreciation. For this my initial cost is 3.5 lakhs. Every year how much depreciation it is going to be there? Depreciation would be 3.5 minus 0 divided by 5. Why 5? Because the equipment is lasting for 5 years. Accounting period is given to be 5 years. So, every year my depreciation is going to be 0.7 lakhs. Right now, I will assume that tax rate is, let us say, 40%. Assume tax rate to be 40%. Assume this. Tax rate is 40%. Now, I will calculate my income, my expense, and then I will see what would be my tax implications, and then I will calculate the net income, and that will be shown in post tax cash flow diagram. So, I will continue with this. Now, my income for year 1 is 2.5 lakhs. In fact, this calculation will be same for straight line methods for all the years, because every year we are paying the same amount of, we are calculating the same amount of depreciation. So, income is 2.5 lakh, expense is 0, because expense in the problem it is saying that there is no expense. So, it is 0. Now, depreciation is 0.7 lakhs, 0.7. So, my total expense becomes 0.7. I have added these two. Expense 0, depreciation also we are considering as an expense, although no real money is flowing out of your pocket. This is very, very important. No money is going out of your pocket, but you are getting some benefit from the government, right. So, total expense is this. So, my taxable income would be, taxable income I will call, would be equal to this minus this. So, 2.5 minus 0.7, which is equal to 1.80. How I have arrived at 1.80? By subtracting 0.7, which is the total expense, from my gross income. Gross income is 2.5 lakhs. Now, on this, suppose I take 40% tax. So, the tax would be, tax at the rate of 40% would work out to 1.8 into 0.4, which would be 0.72. So, what is happening? I am getting a tax liability of 0.72 lakhs only. Now, remember that if government would not have considered depreciation as an expense, my tax liability would have been very high. Why it has come down? Because government is giving me benefit of deducting depreciation from my total income. So, what is the real income that you are getting? Net income. Net income which will go in post tax cash flow diagram would be 2.5 minus 0.72. So, it would be 2.5 lakhs which was my gross income minus 0.72, which will be equal to how much? 1.76, 1.78? Yes, this is equal to 1.78 lakhs. Is it clear to you, technology class? Very good. So, this is what now I will show it in the post tax cash flow diagram, and this will look like this. You have 3.5 lakhs here, and every year I have 1.78 lakhs, 1.78 lakhs, 1.78 lakhs, 1.78 lakhs, and again at the end of it 1.78 lakhs. This is year 1, 2, 3, 4, 5. This is at t is equal to 0. Now, this is what I call post tax cash flow diagram. Post tax cash flow diagram using which method of tax depreciation? Using a straight line method of depreciation. Now, if I am using different method of depreciation, say for example, sum of years digit method of depreciation, every year my depreciation would be different. So, every year my tax liability would be different. So, naturally every year my net income would be different. So, can you just try working it out with sum of years digit method, let us say. So, for this, if you are using sum of years digit method, I call this as, let us say, SOY method of depreciation, sum of years method of depreciation. First year, how much would be the rate of depreciation? It would be 5 upon 15. Second year, it would be 4 upon 15. Why 15? Because the sum of years for 5 years would be 15. 1 plus 2 plus 3 plus 4 plus 5 is 15, which is 5 into 6 divided by 2. So, first year depreciation would be 5 by 15 of what? This would be 3.5 minus 0. Total book value 5 by 15%, or rather 5 by 15 multiplied by 3.5 lakhs would be your rate of depreciation, or rather the total depreciation for year 1. Let us say I call this as Y1. Y2 would be 4 by 15 of 3.5 minus 0. Year 3, how much it would be? 3 by 15 into 3.5. Year 2, it would be, sorry, year 4, it would be 2 upon 15 into 3.5, and finally last year, which is Y5, will be 1 over 15 into 3.5. So, these are different depreciation values for different year. So, first year how much is the value of depreciation? This is 1.4 lakhs, right. Second year how much it is? This is equal to how much in second year? 0.84. It would be 0.84. Like this, you have to work it out for all the years, and you will find that if you total it, if you sum the depreciation for all the years, you will be getting the same value which you got it using a straight line method of depreciation. What are the values for year 3, year 4 and year 5? You can note it down. It is 0.5, then 0.38, sorry, this is 1.17. This will be 1.17. You can make certain correction. 1.17, then you have 0.93, 0.93 for year 2, 0.7 for year 3, and 0.47 for year 4, and 0.23 for year 5. I will illustrate you for one method, and remaining you can do on your own. So, I do the calculation for year 1. My income is how much? 3.5 lakhs. Sorry, 2.5 lakh is my income. Then expense is 0. Depreciation is calculated to be 1.17 lakhs. Please make this correction. Depreciation for year 1 is 1.17 lakhs. So, total expense is coming to be same. Total expense is 1.17 lakhs. I am adding 0 and 1.17. So, my taxable income, how much it is? Taxable income, it is going to be 2.5 minus 1.17. How much is this? Is equal to 1.33. Now, I have to pay tax at a rate of 40%, tax at 40%. So, this works out to 1.33 into 0.4, and which is equal to 0.53. This is coming to be 0.53. So, what is my net income? It is going to be 2.5 minus 0.53, which is going to be equal to 1.97. So, this is for year 1. Same way you have to calculate the net income for year 2, for year 3, for year 4 and finally for year 5. So, your tax post tax cash flow diagram would be something like this. Here you have to pay 3.5 lakhs and you are getting different incomes at different point of time. Year 1 you have 1.97 lakhs. If you want to calculate other values, I will give you. Year 2 you will get 1.87. These values please cross check at your end. Year 3 it is 1.78, 1.78. Year 4 it is 1.69, and finally year 5 you are getting 1.59. Please check these values 1.59 lakhs. This is year 1, 2, 3, 4, 5. This is post tax cash flow diagram. Using sum of years digit method, sum of years depreciation method. Is it clear? Now using the third method of depreciation, which is a double declining balance method, same process will be repeated. That means we will calculate the depreciation for all the 5 years. What we will do? We will calculate the depreciation for year 1, we will calculate the depreciation for year 2, year 3, year 4 and year 5, and then since expense given is 0, the depreciation itself would be the total expense, which will be subtracted from the gross income to get the taxable income. Tax is applicable at a rate of 40% on this. So, you multiply 0.4 with this taxable income to get the net income, and that is what you show it in post tax cash flow diagram. So, I will draw this diagram for double declining balance method also. It is 3.5 here, then here it is 2.06, 2.06, then I have 1.84, then 1.70, then for year 4 I have 1.65, and finally for year 5 my net income is 1.65. So, year 4 and 5 I am getting the same net income. This is year 1, 2, 3, 4 and 5. This is time t is equal to 0 here as well as here. The last one, that the second diagram, refers to post tax cash flow diagram using double declining balance method. This is using DDB. I call this as double declining balance method, and based on this I have drawn the post tax cash flow, right. This is using double declining balance method of depreciation. I hope it is clear to you, technology class? Yes. Okay, good. Now, this is as far as case 1 is concerned. Case 1, what we had taken? Income alone. We had assumed that there is no expense, and that is why when calculating total expense we took only depreciation. Now, we will see case 2. If you see this slide, this gives you all the details which we have worked out just now. I will send you this particular slide and you can cross check your answer, right. Now, we move to case 2. If you see in case 2, here in this case I am assuming that only the operating expenses are given. The problem is silent about income part. This is another extreme. In first case we saw only income, no expense. Now, we are taking a situation in which only operating expenses are given and the problem is silent about the income part. So, if you just see this slide, as before we assume that some equipment has been purchased for 3.5 lakhs, same data. Life is again 5 years, and salvage value, for simplification we are assuming it to be 0. So, first line is same. Now, we further assume that there is no data provided on the gross income part. So, unlike previous problem, here the problem is silent on income part. We assume that there is no income or the figure on income is missing. Now, further let us assume that the different deductible expenses to operate the equipment are rupees 1 lakh annually for all the 5 years. So, this is the operating expense, and we are assuming, please remember that this is our assumption that all the expenses that are given to me in this problem all are eligible for tax benefit. Whereas in real life situation there would be some expenses which will be giving you rebate or tax rebate you can claim on that particular expense. Not all expenses are going to give you tax benefit, but for this problem I am assuming that we are getting the benefit for entire expense. Whatever we are spending, government is giving me tax benefit. But in real life situation this may not be the case. Sometimes only few expenses are given tax benefit. For example, if the company is giving training to its employee, or for example if the company is spending for some social upliftment, the company is operating some hospital, some charitable work it is doing, or the company is sponsoring the students or its employee for higher education, those expenses you will find that they get tax benefit. So, in our problem we are assuming that all the expenses that are given to me are admissible for tax rebate or tax benefit. So, based on this figure, can you draw the pre-tax cash flow diagram? What are the information given to you? Equipment costing you 3.5 lakh right at the beginning. Equipment is lasting for 5 years. No salvage value. Equipment further requires 1 lakh annually for next 5 years to operate it, and there is no information on the income that it generates. So, pre-tax cash flow analysis or diagram preparation is very easy for this. Once we draw this, we will follow the same process. We will use straight line method of depreciation, we will use double declining balance method of depreciation, and we will also use sum of years digit method of depreciation to understand the concept. So, we will work it out again for your benefit. Let us start with pre-tax cash flow diagram again. So, here what you find, 3.5 lakh you are spending right at the beginning at time t is equal to 0. At year 1 you are spending 1 lakh, year 2 again 1 lakh, year 3 again 1 lakh, year 4 again 1 lakh, and year 5 again 1 lakh. So, this is 1, 2, 3, 4, 5. No salvage value, no income information. This is the pre-tax cash flow diagram. Now, I will illustrate with the help of straight line method of depreciation. So, for year 1 to year 5, y1 to y5, if you go for a straight line method of depreciation SLD, the depreciation would be equal to, as before, 3.5 minus 0 divided by 5, which is equal to 0.7 lakhs. Now, my income is 0, expense is given, it is equal to 1 lakh. Depreciation I calculated to be 0.7 lakhs. What is the total expense then? it is equal to 1.7 lakhs. I add these two. Right? So, how much tax benefit we are going to get? Please remember, this is slightly confusing, but if you try to understand it deeply, you will be able to understand it. The tax saving would be at a rate of 40%, 1.7 into 0.4, which would be equal to 0.68 lakhs. So, what is your net expense? The net expense would be 1.0 minus 0.68, which is equal to 0.32 lakhs. Although there is no income, but then this tax benefit we are getting, and this is getting subtracted from my total operating expense, and my total operating expense has come down. So, if I draw the cash flow diagram post tax consideration, how it would look like? 3.5 lakhs as before, that you have to pay right at time t is equal to 0. Year 1, year 2, year 3, year 4 and year 5. 1, 2, 3, 4 and 5. What is this value? What is this? All these values are going to be same, because for us depreciation is same constant throughout the life of the equipment, because we have used a straight line method of depreciation, and this value is equal to 0.32 lakhs, 0.32, 0.32, 0.32. Here also it is equal to 0.32 lakhs. This is what it post tax cash flow diagram using straight line depreciation method. Is it clear? In physical sense you must be clear. If you want just in a layman terms, you can do it like this also. You can subtract the total expense from the zero income, right? Your income is 0, total expense you have found it to be equal to 1.7 lakhs. So, your net income is 0 minus 1.7 lakhs, which is minus 1.7 lakhs. So, the tax that will be applicable would be minus 1.7 into 0.4, which would be minus 0.68, and this you subtract it from 1 lakh. So, that is coming to be 0.32 lakhs. That is why I tried to discuss this problem under 3 headings, 3 cases. In first case we saw income alone was given, it was easy to understand. This is slightly difficult to digest, but I hope you must be clear of this concept now. Is it clear to you, technology class? Yes. Fine. Now, on the same line, please try to work it out with sum of years digit method and double declining balance method. I will give you the answer. You can just note it down from here. This is 3.5 lakhs. This is 0.13. then you have 0.23, then you have 0.32, then 0.41, and finally at the end of 5 years it is 0.51. This is using sum of years. Please cross check this.
Sir, in sum of years, first year depreciation is 1.167.
Yes, so you will get the benefit of
1 lakh full.
yes. So you will get 0.13. You just have to cross check it. This is post tax net expense. Cash flow diagram, you can cross check it. I will give you the answer for double declining balance method also. As before, at time t is equal to 0, it is 3.5 lakhs. For the first year you are getting 0.04, second year 0.26, third year 0.40, fourth year 0.45, and again in year 5 you have 0.45. This is using double declining balance method. Please note down this, and you try to work it out by calculating depreciation for each year separately, because in these two methods depreciation won't be constant throughout the period of equipment. So for each year you have to do different computations, and then you will have to work it out. Just try it at your end. I have done this calculation and I will be sending it to you. If you just see this particular slide, it is giving you the computations pertaining to case 2, that means when expense is given. Now we will see the third and final case, in which we are having the information both on yes this one you are finding some different answer. A straight line. The depreciation would be constant throughout, which will be equal to 0.7 lakhs. What I will do, I will take your question at the end of this lecture. Fine. Now we move to case 3. In this particular example, I am assuming that I have information both on income and expense. So as before, here again we assume that the equipment has been purchased for 3.5 lakhs. Its life is 5 years and the salvage value is 0. Same information I am using for this case also. Now I am further assuming that the gross income is 2.5 lakh every year and the expense, operating expense admissible under tax benefit is 1 lakh. So you can see this is the combination of both the two cases which we discussed earlier. So I have clubbed both the data and this is the combined problem. So if you just see the data, it says equipment has been purchased for 3.5 lakhs. Life is 5 years. No salvage value. Expense is 1 lakh every year. income is 2.5 lakhs every year. Now, as before, step 1 would be draw the pre-tax cash flow diagram. Very simple to make. Pre-tax cash flow diagram. And then in step 2, I will assume for a straight line method, I will calculate the depreciation. I will add the expense part in this, get the total expense, subtract it from my gross income. I will apply the tax on this taxable income, and then I will get the net income. That will be shown in post-tax cash flow diagram, and the similar steps we will be following it for other two methods also. So we will start with pre-tax cash flow diagram again. We will start with pre-tax cash flow diagram again, which I will draw it like this. I am purchasing the equipment for 3.5 lakhs. This is costing me 1 lakh every year towards its operation. This is year 1, 2, 3, 4 and 5. No salvage value. And in addition to this, I am given the information that the annual income using this equipment is 2.5 lakhs. $2.5 and 2.5. This is at time t is equal to 0. This is pre-tax cash flow diagram. Pre-tax for third case. Now I will illustrate you with the help of straight line method of depreciation first. So let's assume straight line depreciation. Income for year 1 and for all the years is 2.5 lakhs. Income is 2.5 lakhs. Then income is just a moment. My expense is 1 lakh. The depreciation that I have calculated is, how much depreciation it would be? 0.7 lakhs. From where I have got this? 3.5 minus 0 divided by 5. So what is my total expense? Sum of these two, it is equal to 2.7 lakhs. It is 1.7 lakhs. $1.7 lakhs is my total expense. So my net taxable income is equal to 2.5 minus 1.7, which is equal to 0.8 lakhs. Now how much tax I have to pay? Tax at a rate of 40% is 0.32 lakhs, which is nothing but 0.8 into 0.4, right? So I have to pay a tax of 0.32 lakhs. So what is my net income? It would be equal to 2.5 minus 0.32, which is equal to how much?
Not minus 1. Another minus 1 is 0 square.
Minus 1, which is equal to how much it is coming? 1.18 lakhs. This is coming to be 1.18 lakhs. So my post-tax cash flow diagram would look like this is 3.5 and 1.18, 1.18, 1.18, 1.18 and finally 1.18. This is at time t is equal to 0. This is at 1, 2, 3, 4 and 5. This is nothing but my post-tax cash flow diagram. Using straight line method of depreciation. Now similar analysis you can perform for the other two methods of depreciation, which is sum of years method of depreciation and double declining balance method of depreciation. Right? I will give you the answer for other two cases also. The post-tax cash flow diagram for sum of years digit method, it is going to be like this: 3.5, 1.37, 1.27, 1.18, 1.09 and finally 0.99. This is at year 1, 2, 3, 4, 5. This is using sum of years method of depreciation. This is using sum of years method of depreciation. And finally the last one, (3.5) at time t is equal to 0, 1.46 here, 1.24, 1.10, 1.05 and finally again I have 1.05. This is using double declining balance method at end of year 1, 2, 3, 4 and 5. The calculations are quite similar. Only thing, if a straight line method of depreciation is given, you don't need to calculate the depreciation for every year. So same set of calculation you can repeat. Whereas for the remaining two methods, sum of years digit method as well as double declining balance method, you have to perform the calculations for every year separately. So the problem becomes little lengthy, otherwise concept wise it is all same. So if I just summarize the whole steps or a whole process, it is like this. Depending on whether your income is given or expense is given or both are given, you can follow the same process. First step is to draw the cash flow diagram. Second step, you have to calculate the depreciation using the method that is specified. Then you have to see whether your expense is given, other expenses admissible under taxes. You get the total expense, subtract it from your gross income to get the net taxable income. Now on this taxable income you apply the appropriate tax rate, and that would be your net income when subtracted from the taxable from gross income. So I hope you must have understood the implication of depreciation and taxes on your decision making. We are living at post tax cash flow diagram itself, because afterwards the process is same. Once you have got the cash flow diagram made, you can apply either the present worth method or the future worth method or the annual cost method or incremental rate of return method. Any method you can apply once you have got the cash flow diagram, post tax cash flow diagram with you. Other steps remain same. Whatever decision rule we had followed pre-tax cash flow diagram, the same set of rules are applicable for post-tax cash flow diagram. So this is as far as our discussion on part 1 of this lecture was concerned. I had told you that I will be giving you an illustration on depreciation and tax considerations and its impact on decision making. Now part 2 of the lecture is evaluation of public projects, public sector projects, that we will be taking up now. But before that, I would just like to tell you something about inflation, because if you remember the assumptions that we had made, for our analysis in beginning classes, we had said that we are assuming that there is no inflation. So that was one of the assumptions to simplify our calculation. But in real life situation, you find that some amount of inflation would be there in the market. So how to take care of inflation in our analysis, we will discuss briefly about that. As you know, any construction project that you see, you must have been noticing that they take a number of months, sometimes number of years also to complete that. If you see any infrastructure project, that must be taking about 2 to 3 years time. Now during this long period, it is not proper to assume that the prices would be constant. You will find that the cost of labor, materials, plant and machinery, they may change drastically. So how to take care of such things in our analysis? If it is for a short term project, may be fine, because there won't be much price variation during such a short period. But in cases where you have your projects is spanning for large number of months or maybe sometime number of years, in such cases it is not proper to neglect the inflation aspect. But some people support the argument that since the inflation results in the price rise in all goods, right, it is not that the prices of item X only will be increasing very high and prices of item Y will be constant, very rarely you find such phenomenon. What happens in usual situation? The price rise would be almost uniform. So, if you find that the cost of your daily usage items have gone up by 10%, you will find that the price of eatables are also going up by nearly same percentage. So, some people what they argue is that if the price rise is uniform, it will impact all the alternatives uniformly. Suppose I have alternative A, B, C, D like this. So, if inflation is applicable for alternative A, it is also applicable for alternative B, alternative C, and so on. So, by putting this argument forward, they try to neglect this inflation aspect, and then they say that since it is applied uniformly, so even if I neglect this, it is all right. Clear to you? Now, if you see the definition part of it, it is defined as the increase in the price level resulting in decrease in purchasing power of money. So, this is as far as definition of inflation is concerned. It is defined as the increase in the price level resulting in decrease in purchasing power of money. So, this is as far as definition goes. And the what about first set of argument? People say that since it is uniformly applied, we can as well neglect it. But in economic analysis, what do? We just can't always press this argument. So, some people have suggested certain rule to take care of inflationary market. So, as far as India is concerned, you will find that our normal practice is to use 12% as discount rate. In your country also I am sure this must be the discount rate. Discount rate is what? The interest rate that we have been using it in our analysis. In layman's term, you can understand that both are nearly same, discount rate and your interest rate, although in exact analysis they are not treated equally, but for our purpose we assume them to be same. Now, we have one code which is called IRC SP61. They specify that whenever you find there is a large difference between the rate of inflation and interest, here they are distinguished. If you find that the rate of inflation and interest rate are widely varying, then they modify the formula for calculating the discount rate, and they give the formula for discount rate calculation like this. I will show you, I will give you the formula like this. See, I told you that it is normal practice in India to use a discount rate of 12%. That means whatever analysis we are making as far as public projects are concerned, there we take 12% interest rate. As an assignment, what you can do is you can find it out what is the discount rate that Ethiopian government takes while evaluating their projects. This you have to find it out and tell it to me. What is the discount rate followed in your country for evaluating public projects, right? Now, if there is a wide difference between inflation rate and interest rate, then we modify our discount rate. Suppose this difference is very high. In some African country, you will find that the rate of inflation there is very, very high. Here in India right now we have an inflation rate of about 6 to 7%. In India right now we have an inflation rate of 6 to 7%. It keeps on varying. For example, just 3-4 months back it was running in double digit. That means it was about 12 to 13%. But then the rate of inflation depends on a number of factors. The cost of crude oil or the price at which you are importing it, and the crops that you have generated for a particular year. The other factors also influence. Right. So, if there is a wide difference between these two rates, inflation rate and interest rate, then we use a modified formula to calculate discount rate. Modified discount rate is given as 1 plus interest rate I divided by 1 plus inflation rate minus 1 100 into this. So, the formula to calculate the modified discount rate in cases where there is a large difference between the two rates, that is inflation rate and interest rate, is given as 1 plus interest rate divided by 1 plus inflation rate minus 1 into 100. So, if you just try to work out an example, suppose the interest rate is 12% and rate of inflation, let us say it is 8%. Can you work it out what percentage of discount rate you will be using for evaluating your projects? If the interest rate is 12% and rate of inflation is 8%, please find it out the modified discount rate that you will be using it for your analysis of public projects. So, you will find that you are getting an answer of about 3.7%. You will be getting an answer of 3.70. Please cross check it. It would be 1 plus 0.12 divided by 1 plus 0.08 minus 1 multiplied by 100. So, you will get a figure of 3.70%. That means, if you find that there is a large difference, so instead of taking 12%, you evaluate on the basis of 3.70%. This is the impact of inflation on our analysis or evaluation. So, in this lecture what we have covered till now? We have covered the impact of depreciation and taxes, and through an illustrative example we have seen how to draw the post-tax cash flow diagram. From post-tax cash flow diagram, the process remains same. You have to use any of the methods that we discussed, and towards the later part of the lecture we covered the impact of inflation on the discount rate. First we said what is meant by inflation. You saw that it is a general increase in price level and thereby decrease in purchasing power of money. Then we also discussed the viewpoint of one set of people who say that when the price rise is uniform, so the inflation would be applicable for all the alternatives equally, so there is no need to consider the inflation. Whereas one set of people, what they say, they say that when you find that the difference between rate of inflation and interest rate is void, in such cases you should modify your discount rate, and then we saw the formula for discount rate, modified discount rate, which we defined as 1 plus interest rate divided by 1 plus inflation rate minus 1 multiplied by 100. So, I think the other objective of today's lecture, I think we won't be able to take up. So, what we will do in next class, that will be held tomorrow, we will be discussing the evaluation of public projects using benefit cost ratio, and then I will take one example of a public project. Say we will take some example of dam construction or some hydropower construction, and then we will see how to analyze them. You will find that there we use different method of evaluation. So, we no longer use present worth method or future worth method there, rather we use a term, a benefit cost ratio method of analysis, which of course rely on either present worth or annual equivalent method, but you will find that the real difference lies in the two philosophies. Public projects, you will find that profit is not the main objective, right. There are many other objectives of public projects that we will be discussing using some example. So, what I will do is I will conclude this lecture right now, and then I will try to take your queries or doubt that you have concerned with today's lecture or the lecture that we had it in the past. Thank you. Yes. Yes. Case 2. Okay. I will just show you. You are talking of this.
Yes.
Yes, what is your doubt in this?
One lakh expense,
Yes.
then you have that 0.68 at 40%.
Yes.
The net expense minus plus 1 minus
0.68.
0.68.
Yes.
Both are expense. How to subtract?
No, this is what you have to understand. You are getting a rebate of this much amount by the government. The problem is confusing because your income is 0. Right. Now, suppose you put the income as 10 lakhs. Right. What will happen? You will subtract 1.7 lakhs from 10, and you will be paying tax on what amount? 10 minus 1.7, which is 8.3 lakhs. So, what you got? You are getting a benefit of tax on 1.7 lakhs at a rate of 40%. So, that is why we are deducting it from operating expense. So, your net liability is coming out to be 1 minus 0.32 only, sorry 1 minus 0.68 only, which is 0.32 lakhs. Now it is clear? this amount is not the tax that you are paying, rather this is the benefit of tax, because you have spent some money and government is giving you benefit on that amount, and that's why I am deducting it from my gross expense or operating expense.
If the calculation is by assuming as if there is income, I am getting benefit of 0.68.
Yes, exactly. Suppose some income would have been given, what I would have done? I would have subtracted the tax benefit from that income. So, what you do to understand it clearly, just replace income 0 with some value, and then it will be clear. That's why I have taken case 3 as the last example. We did the same thing there also.
What if I assume
Which one?
the 0. On the same question,
Huh?
what if I assume the 0.68 as an expense and add the negative value to 1? The answer will be the same. Am I on the correct way?
Okay, your income is 0.8. Okay, what you are telling is your, can you tell me your question again, please?
Yeah. Let us assume that the tax, which is 0.68, is assumed to be gone.
Okay.
No, as an expense, sorry. As an expense,
Other expense is how much?
0.68.
Okay. So your net expense would be 0. This is what you are telling, expense is 0.68 and tax is 0.68. This is what you are telling?
No. The tax, the after tax expense, that means.
So then net expense would be 0.
Okay.
Now one thing I didn't tell you, which you have to read it from the books. You must have seen that I am taking, let's say, 3.5 lakhs here, right? Then let's say at the end of year 5, suppose you sold this equipment for 1 lakh. Let's say salvage value is 1.0 lakhs. So there are tax laws which has different tax structure for this income. This is called capital gain and capital loss. Sometimes it may so happen that you may sell the equipment for some loss. So then there are different tax laws. Then sometimes you may earn more money by selling something. So you may have to pay different taxes. So that you can study capital gain and capital loss, the method of taxation prevailing in your country. Okay, but just understand that any gain and loss, capital gain and loss, are subjected to different tax rates. If for normal cases tax is 40%, maybe for capital gain or losses the tax could be at a rate of 20%. So there could be wide variance in these two tax structure. Please find it out, the existing or the prevailing tax laws in your country.
Hello.
Yeah?
In case 3,
Interest rate, yes?
in case 3,
Case 3. They're talking about case 3.
Okay, case 3, yes.
Method we deduct 1% from the net income.
Yes.
Is that the correct way? It is 7.
What I will just show you. उसमें how much we were getting?
So 1.18.
1.18 वाला slide होगा ना?
So he is asking like why we haven't deduct 1.17 instead of 1.
I will just show them. This one he is asking why we have not deducted.
1.7 instead of 1.
Okay, there we made mistake. Yes, he is right. See, you are right there.
Sir, why 1.7 is a depreciation? You are not going to deduct that.
No. Which one? Depreciation is 0.7 and expenses. We have done it correctly. This is correct only. Now, what the doubt you must be getting is like this. I will tell you where your doubt comes from. Yes. If you just see, this is how we had made this. Clear? Now, if you would have wanted, you could have shown it like this. This you could have taken as 2.18 and this as 1 lakh. I think this is your doubt. We could have done it like this, but I have given you the net value directly. Is it clear now?
We have already deducted from the growth.
Which one?
2.25 minus 0.32 minus 1. Why do we make minus 1? There, yes.
Because we are trying to get the net income. If you don't want to do this, you can remove it from here, right? What you can do is 2.5 minus 0.32, which is 2.18, and then show 1 lakh separately. Either you can do it like this, or straight away you deduct from there. Is it clear now?
Yes.
Okay, good.
Thank you.
And these 3 lecture notes, lecture note 11, 12 and 13, I will be mailing you by tomorrow. Okay? Okay, good night.
Wide variation between interest and an inflation rate.
हाँ.
What is this wide variation?
वाइड वेरिएशन जैसे मान लो अब इन्फ्लेशन बहुत बढ़ जाएगा.
तो सर मैं बहुत की रेंज में पूछ रहा हूँ.
Range actually I don't remember actually, but there are some ranges specified.
Some laws
हाँ.
which way
Yes.